So we have this question on hand, and wanted us to look at it and see how best we can answer it. This particular question here. While studying it, I realized it's question in fours, or four different sets of questions. The first question is asking that what is a withholding tax? We have to provide three income which are exempted from withholding tax. And the third one is a small theoretical question on its own, or it's a practical assessment question. The fourth one is also a practical assessment question. But let's look at question one. Question one is telling us that what is a withholding tax? And we know that withholding tax is the tax that is withheld from a payment to a person by a withholding tax agent, and is later paid to the Ghana Revenue Authority, basically at 8% or averagely at 8%. But you don't need to remember the rate, because there are various incomes and then different rates that are applied. Okay, so let's say Mr. A is going to pay Mr. B for a work done. If the work Mr. B has rendered or done this, the work Mr. B did for Mr. A qualifies to be part of withholding tax, or qualify as an income to deduct a withholding tax from them. It means that before Mr. B pays Mr. A have to deduct the withholding tax from Mr. B's money and then pay the rest to Mr. B. Does it end there? Mr. B is obliged by law to go and pay that withholding tax he has deducted from Mr. A's money to the Ghana Revenue Authority within 15 days. Then has to come and give a withholding tax certificate to Mr. A. So by the end of the year, if Mr. A is preparing his account, Mr. A have to factor in that withholding tax certificate as tax that has been paid already, to reduce his tax liability to be paid at the end of the year to the Ghana Revenue Authority. So that's basically what it is. So if you are asked what is a withholding tax, I'll write this one. Question one. It's a tax which is deducted at source by withholding tax agent. And when we talk of withholding tax agent, it's a person required to deduct tax when making payment to another person and accounted for later to the Ghana Revenue Authority. So all what I said is just a simpler explanation to it. It is a tax which is deducted as source by a withholding tax agent when making payment to another person and accounted for later to the Ghana Revenue Authority. Then you are being asked incomes incomes that are exempted from tax. So incomes that are exempted from withholding tax: when a resident financial institution is paying interest to a resident financial institution, it is exempted from withholding tax. Premium paid to a resident insurance company is exempted from withholding tax. Payment for goods for sale of goods which constitute trading stock for both the vendor and the purchaser. So the point two, what they are trying to say is that if you are a seller of a laptop and I'm a buyer of a laptop, okay, so he sells laptop, I also sells laptop. Then I come and buy laptop from you to go and sell. At the end of the day, you don't need to charge me withholding tax. That is basically what it means. So when two parties deals in the same commodity in terms of sale of goods, then there is no withholding tax on that one. That's basically what it means. So once I'm buying it for the purpose of selling, then there should not be any withholding tax on that. I get it the scenario. Then when I'm buying it for consumption, then you have VAT and withholding coming if it qualifies for withholding. Okay. The interest or dividend paid or credited to another holders or member of the investment in an approved unit trust scheme. So you can just see a dividend paid to a member in a unit trust scheme. That's all. If the unit trust is not approved, how even go and set it up? Interest paid to a resident financial institution. Payment made to persons specifically exempted from income tax. So these are some of the incomes or some of the payments for which withholding tax should not be deducted. So when you are making any payment that falls within this category, you don't need to withhold tax from it. And by so doing, if anybody is also paying money and the person is going to deduct withholding tax from the person, he must have invested in my industry or this income by the law doesn't qualify for withholding tax. So I'll put 4 here, the question asks for 2. Or yeah, I love the number 6. That one falls part of my industry, the travel and tour industry. The travel and tour industry specifically routes to the Ghana Revenue Authority, that's the Ghana Tourism Authority, specifically routes to the Ghana Revenue Authority to exempt the Tourism Authority from withholding tax and VAT. So in the airline industry, we don't charge VAT, we don't charge withholding tax. If you go and buy air tickets in Ghana here, nobody charges you withholding. If anybody is doing that, the person is corrupt. If you render any service for them, they are not supposed to take withholding from it. Likewise, when they also render any service to you, you are not supposed to take any withholding from it. That is basically what it is. So this is just the answer for question 1 and question 2. Now let's look at question 3. Big Boy Company Limited and Orphan Company Limited operated in a non-production and production sector respectively, or non-profit and profit sector. I think it's going to be non-production and production sector respectively. Assuming that both companies reside assuming that both companies recorded business losses and profits as follows. Now, the question here is that they are not telling us which of the company is in the production sector. They are not telling us which of the company is in the non-production sector. but it's a both company operated in a non-production and production sector. So it is assumed that big boy company can operate in the production sector for some reason, can also produce in the non-production sector for a reason. So let's say it's a manufacturing company. So it does the manufacturing and also does the sales and marketing by itself. It's fine now. Now, in the year 2010, the loss recorded is 40,000. 2011, the loss recorded is 100,000. 2012, loss recorded is 120,000. 2013, loss recorded is 105,000. 2014, loss recorded 680,000. 2015, profit recorded is 740,000. 2016, profit recorded is 440,000. Assuming corporate tax rate of 25%, calculate the tax payable in 2015 and 2016. So assuming corporate tax is 25%, and by law, corporate tax is 25%. Just calculate the tax payable. Now, I just wanted to draw your attention to something. You see that you are doing, or you were if you are in, let's say, taxation of branch profit, you may get confused as to this question, whether are you going to treat it, are you going to deduct branch profit from it? No, but this one they are not telling you that it's a branch or it has branches where the branch is repatriating profit to the mother company or whatever. It's a straight away a single entity, or it's a straight away independent company on its own. Okay. So this company, whenever they prepare their accounts at the end of the year, they pay corporate tax and then case closed. So for them, we don't have anything like carryover losses to the next year or whatever. No. They don't have anything like that. So if I should explain that, let's say you should calculate the tax rates for all of them for all the years. 2010, they are not going to pay any tax. You don't even need to put a pen there and calculate anything. All right, for 2010, no tax to be paid because the company has made a loss. 2011, no tax. 2012, no tax. 2013, no tax. 2014, no tax. Because the company has made a loss. So, in that order, you don't pay any tax. That is number one. Then, number two, 2015, they made a profit. So, you calculate that. 2016 made a profit. So, you calculate that. I get to the scenario. That is basically how we are going to. So, let me see. The year, the 2010 to 2014 year of assessment. The 15 year of assessment. So one thing you are supposed to also know is that whenever they are describing profit, we have two forms of profits when it comes to tax liability. We have profit before tax, and then we have profit after tax. So you are supposed to know. Like the way they are putting this one, for example, profits as follows. So these ones are the profit before tax. If the profit is a profit after tax, they will always state it. Always, if it is a profit after tax, add it to it that this is a profit after tax. The profit before tax, they usually don't add it. So the profit for 2015 year of assessment is 740,000. So profit is 740,000 multiplied by, let me do this one. Tax at profit is 25% of 700,000. So let me do it like this. Let me just prefer doing something in Excel. 25% on 740,000. So you get 185,000. So what you get there is called profit after tax, which is equal to 555. So that's the tax liability for 2015 year of assessment. Tax liability for 2016 year of assessment. The profit is 440,000. So you put 440 here. So you get 110,000. So if I'm deducting from it, then I should be getting 330. So this is my tax liability for 2016 year of assessment. You have answered question 3 successfully. I'll do question 4 in another video to make it more simpler. Okay.